colleagues, good morning, good afternoon. We hope that you and your families are well in these difficult times. On behalf of PULSAR team and the WorldBank, and despite the ongoing circumstances, we are happy to welcome you to our 7th PULSAR webinar entitled Strengthening Fixed Asset Management Through Public Sector Accounting. The main objective of this smart interactive talk is to present the key finding of the recently published PULSAR knowledge product that has the same title as the event. In order to achieve the proposed objective, today we are going to have an extraordinary panel of experts. I would also like to remind you that all presentations will be briefly available on our PULSAR and Center for Financial Reform website. Please also post any questions you might have using your preferred language directly in the chat. Without further ado, and giving our ambitious agenda today, I pass the floor to Daniel Boyce, Practice Manager of Governance Team for East Europe and Central Asia, to share with us some opening remarks. Dan, the floor is yours.
Thank you, Dimitri. Good afternoon and good morning to everyone. I'd like to information subsequently captured in financial reports, and why is this information useful for stakeholders, and what type of stakeholders are we talking about? The paper has much more detail in these areas, but today's discussion will also focus on some other aspects, such as good practices rooted in the different country experiences, some of which we'll hear today, and relevant standards such as IPSAS, key issues and challenges that are related to fixed asset management through the lens of public sector accounting, a link between fixed asset management and public investment management, which sometimes are spoken as one and the same, but they can be distinct but related to areas, and what is the relevance of fixed asset management for broader PFM reforms. The way the private sector investors may use information prepared by governments is also relevant and brings kind of a market to this issue for governments, for the investors to make decisions, and for the information that's produced by governments to be of the best quality to affect these decisions. We'll also hear specifically the presentation of the Lithuania and Poland experiences to bring this more to practical use for those of you working in ECA countries. We also hope it will be useful for colleagues from Latin America and Caribbean countries. Thank you again for being with us today. We hope you enjoy the event and that you'll be able to join 2 other upcoming events, one on sustainable reporting and one on first-time Ipsos adoption, which will be taking place in the next few weeks. So we go back to Dimitri to continue the proceedings. Thank you.
Thank you, Dan. Now I would like to invite Andres and Pascal to share their main reflection on the topic in the capacity of the main authors of the paper.
Thank you very much, Dimitri, for hosting us once again, and a warm welcome to our friends in the PULSAR countries, y también una bienvenida muy cordial a nuestros amigos en los países de Latinoamérica.
And also cordial welcome to our friends in Latin America. It's a great pleasure to be with you today.
But of course, I'm very happy to answer any questions also in Spanish if they should arise. Really, it's my great pleasure also to introduce 2 things to you. Firstly, what we have mentioned, which is the new product, and which you see right on the next slide. This is the product we were able to produce over the last couple of months together with the WorldBank. And this was funded, and I would like to acknowledge this as well, was funded by the governments of Switzerland and Austria. You will have the pleasure to meet also one of my colleagues whom you probably have not met that many times before, Pascal Horny. So Pascal will then take you through the details of this publication. The topic is really one which is, I think, very important to everyone. I mean, I have been working in so many countries around the globe, and I could not find one which is not focusing on that topic. So we are really at the core of many government accounting reforms when we talk about fixed assets. Now, what are fixed assets? Next slide, please. So the fixed assets are basically what is sometimes also referred to as non-current assets, or similar to tangible assets. The only tangible assets which are not fixed assets for the purpose of our study are inventories, and obviously inventories follow their own accounting standard, which is Ipsos 12, and follow slightly different rules as compared to what we have in fixed assets. So fixed assets are, of course, right in the center of those yellow boxes, property, plant, and equipment. This is certainly the most known standard, Ipsos 17. But we do have a couple of other standards which are relevant for fixed asset accounting. And I start from left to right. We have biological assets. We have investment property, then property, plant, and equipment, as I already mentioned, service concession assets, so those assets which are controlled under a service concession agreement, like a private-public partnership, for instance, and then also finance lease assets, so those assets which are under a financial lease agreement in accordance with Ipsos 13. There are some other assets like intangibles, and of course also financial instruments can take the form of an asset if they are on the asset side of the balance sheet. But that's not the topic of this brochure. Perhaps of one of the future ones, but right now we are really focusing on those assets which are highlighted in yellow. Next slide, please. Yeah, and this is basically the structure of this brochure, and Pascal will of course explain more in depth to you what is inside each of the 3 chapters. We have structured the brochure into 3 chapters, which you can see right at the bottom of the screen. How to set up and maintain asset registers. So this is the first chapter, and of course Pascal will explain further what this means, but we do think that actually this is a very good starting point when we talk about fixed assets. You have to register the assets and you have to maintain an asset register. And so this is of course one of the key tasks if you think about implementing accrual accounting, or perhaps also if you have quality problems. I understand, in particular in Latin America, most people already have this, but might have quality issues in their asset registers, and therefore perhaps audit qualifications every year. So really, this is a core task. Second, in the center, then how to capture financial information on assets and bring it into financial reports. Now, of course, just registering the asset and knowing, yes, we have a building, we have a computer is not enough. We have to bring in financial information and make that part of financial reporting. And last but not least, I think both Dan and Dimitri have already mentioned this, it is important to make use of asset information, and in particular in difficult times like the current one in this pandemic with a global economical crisis. It is very important to know what kind of assets we have and what we can do, because quite often assets help us to actually mitigate the effects of the crisis. In fact, the 2019 study of the International Monetary Fund has shown that countries who manage their assets actively are better equipped to the challenges of an economic crisis and are faster to recover after that crisis. So this becomes very critical in all economies around the world. So this is the key structure of this brochure, and with that I hand over to one of the principal authors of the brochure, my colleague Pascal Horny, will take you through these chapters. Thank you very much once again, and I will stay tuned. Pascal, microphone.
We can't hear you. You're still muted.
Can you hear me now?
We can hear you now.
All right, great. Yeah, so thank you, Andreas, for introducing kind of this big picture and yeah, also the main functional mechanism and key administrative pillars that are kind of foundational to public sector fixed asset management. So now, after having kind of set the scene, please let us dive straight into these three guiding questions and elaborate on how asset registry and accounting can be strengthened to support the management of fixed assets. So as already mentioned by Andreas, it all starts with the asset register, because well-maintained fundamentally capturing financial implications of the current asset portfolio, both in terms of stocks and flows. So from a procedure,
Pascal, we can't see the slides.
You can't see the slides. Oh.
No.
You see then.
Since you're reconnected, you might need to share your screen again.
All right. Can you see the screen now?
Yes, now we can see it. Perfect. Thank you.
All right. Sorry for any inconveniences this might have caused. So yeah, so let me just start over. So as just mentioned, it all starts with the asset register, because well-maintained asset registers form the basis for comprehensively capturing the financial implications of the current asset portfolio, and these both in terms of stocks and flows. So again, from a procedural perspective, asset registry is really the groundwork that is required for accounting recognition, which is why basically its activities should ensure the collection of all relevant information. The information that asset registers should capture can be clustered in three areas. The first cluster is technical information on assets, such as the type of the asset and age and condition, to be able to judge the service potential. The second cluster then is legal information, which we need to capture ownership and control structures, so that we know which assets fall in the scope of which reporting entity. And thirdly, we have valuation information or information on the value, such as the acquisition or replacement costs that we need to have respective input for measurement in accounting. Another key aspect that was raised by the practitioners that we talked to in the development of the knowledge product is that, that was frequently mentioned, is that asset registry and categorization should follow the regular information needs of managerial and operational personnel. However, to serve as a purposeful basis for accounting recognition, registries should also collect sufficiently granular and relevant information to fulfill financial reporting requirements. So registry should follow an asset classification grid that is based ideally on the chart of accounts, or that is at least cross-referenced to its nomenclature in the back end, or linked to the nomenclature of the chart of accounts within the IT system in use, where we maintain the asset register. However, and this is a key point as well, we should not just consider asset registers as a pure accounting input, as they usually comprise, as we see, non-financial information regarding the nature, condition, or purpose of the current asset portfolio that could be equally useful as financial information, especially on an operational level. So then the second pillar really is, after we have captured basic asset information, we can construct the financial dimension to accounting. So this includes valuation and capitalization of assets, as well as recognition of consumption of fixed assets that we all know as depreciation, and any financial consequences arising from any economic events along the asset management cycle, so from acquisition, operation, maintenance to disposal and replacement. Certainly, here IPSAS, the International Public Sector Accounting Standards, provide valuable guidelines that are summarized in the knowledge product. But given time constraints, I refrain from introducing you to specific IPSAS standards and recognition and measurement and disclosure stipulations, and I focus exclusively on issues where professional judgment is necessary in the application of IPSAS. One of those areas is the establishment of reasonable capitalization thresholds, and there we've linked the question, what should actually be captured? Given that public sector entities often possess some low-value items whose capitalization would be neither practicable nor proportionate given the efforts necessary for the registry, many countries have established capitalization thresholds. While the IPSAS conceptual framework encourages consideration of materiality and cost-benefit issues, IPSAS does not really provide detailed guidelines for determining capitalization thresholds. So determining capitalization thresholds is not an easy task at all, but it is important to adhere to the essence and purpose of IPSAS as entailed in its conceptual framework. So first of all, to comply with the requirement of faithful presentation, capitalization thresholds may not conceal the underlying substance of a position or transaction. In general, capitalization thresholds reduce completeness of the assets presented. So if thresholds are high, they are in conflict with faithful presentation. However, high capitalization thresholds might be favorable from a cost-benefit perspective that is, however, equally at the heart of the IPSAS conceptual framework. So we realize that there's certain trade-off or tension between faithful presentation and cost-benefit of financial reporting, and this is basically a delicate act. To comply further with the requirement of comparability, capitalization levels should be consistently followed by all reporting entities. which is why it is recommended to specify the threshold in accounting manuals and provide through the accounting manuals further guidance to operational accounting staff. However, it's possible to define different capitalization thresholds for different classes of fixed assets, depending on the information needs. Another point to bear in mind when developing capitalization thresholds is intergenerational equity. Any capitalization and subsequent depreciation basically shifts acquisition costs and value consumption to the next generation of taxpayers. So against this background, jurisdictions that adopted accrual accounting and have more than a decade of experience in its application have opted for different approaches to deal with these trade-offs and issues. New Zealand, for example, basically just differentiates between tangible and intangible assets. Switzerland, as another example, has a more fine-grained approach and differentiates based on the asset class. Australia, on the other side, has specified a unified capitalization threshold for buildings and leasehold improvements, but leaves room for professional judgment for any other types of assets. So we see really, based on this, there's a variety of approaches available on how to determine capitalization thresholds. But it most crucially comes down to the consideration of the guidance provided by the IPSAS conceptual framework that we have listed on this slide here, or with these bullets, and that's just elaborated. What we notice when looking at this table summarizing international practice, compared to Australia and New Zealand, Switzerland has a relatively high materiality threshold or capitalization threshold. Again, from the perspective of fiscal sustainability and intergenerational equity, high capitalization thresholds lead to higher short-term expenditures or expenses, but at the same time kind of reduce accumulated depreciation expenses in the subsequent period. The decision to adopt relatively high capitalization thresholds in the case of Switzerland was really driven by the historical and socially rooted principle of prudence. So this could be a legitimate consideration why one comes up with higher capitalization thresholds. Another area requiring professional judgment in the application of IPSAS and when accounting for fixed assets is estimating the useful life of an asset. As we are probably all aware, the economic fact that the use of a fixed asset leaves some wear and tear over time is reflected under accrual accounting with yearly depreciation charges. One key parameter in computing yearly depreciation charges is the useful life of an asset based on which one might also plan any replacement. Since determination of an appropriate useful life is an accounting estimate, because what can be deemed as appropriate is rather an effect of judgment than a strict accounting policy. So given that, it is advisable to provide different ranges or bandwidths of useful lives for different asset classes, or just to provide some guidance for operational accounting staff. Even with respect to a given asset, such as a road system, different useful lives may apply for different components of the assets, such as the road surface or the drainage of the road system. So main guiding principles available for determining useful lives are provided in IPSAS 17, but basically all of those bullets listed on this slide is qualitative information that should be entailed in the asset registers. So again, what this example shows us, it's really crucial to capture also this kind of qualitative information to be able to come up with meaningful and appropriate accounting estimates. So I jumped a little bit on the slide. So then the last slide. So basically the last step then, after having captured the financial information through asset accounting, the question arises, how can we make use of this information? And the availability of financial information alone will not automatically lead to better deployment of public sector fixed assets or better management of those and better quality in public services to the broader. So to unfold its power, asset information must be leveraged to strengthen the basis for decision making with respect to asset life cycles or project stages. So therefore, enrich existing management instruments, seize controlling opportunities, and develop relevant key performance indicators such as cost per service unit or return on investment to be able to scrutinize current service delivery modalities and deployment or current deployment of fixed assets. To fruitfully integrate such measures into public policy cycles and performance management systems, think of adjusting planning templates and guidelines so that the information has to be considered by default just because the planning template is requiring you to do so. Also, consider non-financial information on assets in decision making. So to capture life cycle costs or total costs of ownership, governments may need to understand how the physical condition of an asset correlates with financial revenues or costs to operate and maintain them. So in the case of more complex assets such as roads, bridges, or telecommunication networks, which typically consist of various components with various useful lives and life cycle costs, governments may find the optimal timing for maintenance or replacement to reduce overall life cycle costs. So we should also have an eye on these non-financial information or qualitative information that is captured in the asset registers. So, I mean, this was now rather brief and just a brief a walkthrough to this knowledge product and some of its features or main features. Given time constraints, we could not capture everything and introduce all the features of the product to you. But the idea basically that public sector accounting crucially facilitates management processes and decision-making is not a novelty, right? However, what the knowledge product, this PULSAR knowledge product does, it substantiates the functional link between accounting and the management of public sector fixed assets. So the knowledge product really provides guidance on how this link could be strengthened by referring to international good practice, stemming from country examples, but also from IPSAS norms. So the product also entails summaries of key IPSAS stipulations regarding recognition, measurement, and disclosure of fixed assets, but also it provides certain generic processes to institutionalize and strengthen asset registry and impairment testing. And I would really invite you to have a look at the product. And I also want to use the opportunity to thank also Dimitri and Andreas and also the whole team at Zurich University of Applied Sciences for collaborating and the development of this product. So thank you for your attention, and I think both of us, Andreas and myself, we stay tuned and are ready for your questions if there are any. I'm happy to answer them. So thank you.
Thank you, Andres. Pascal. Now I would like to invite Srini to discuss the relevance of fixed asset management for broader public financial management reforms in his new capacity of head of PIFA Secretariat.
Thank you very much, Dimitri. Friends, delighted to connect with the PULSAR, connect back to the PULSAR network for the first time in the new year. Hope you're all doing very well. Let me try to share my presentation.
We hope you don't forget how to do it.
Yes, Dimitri, I think it's not showing up when I share.
Let me try to do it on my end.
Okay, I think I got it. Just give me. Okay, so do you have this now?
Yes, can you see it?
No.
Srini, it was already on the screen.
Okay.
Let me share it again. Can you see it?
Yes.
Okay, go ahead.
I can see it. Wonderful. Thanks, Dimitri, and apologies, colleagues, for the technical issue, and thanks, Dimitri, for resolving. Friends, I'll take you back to several years earlier when I joined as Accountant General in a state in India. So I was looking at the financial statements. I saw a real big long number, a very long number in the financial statements of government of Andhra Pradesh, a state in India. I was curious to know what it is. So I went and asked my 3 sets of colleagues. I got 3 different answers, each not matching with the other. So one said, this is fixed assets. Another said, this is cash spent. Third said, this is some sort of a control number. So when we went further and tried to dig a little bit more and check what it is, what we realized is that's a number which from 1956, when the state was carved out of a composite presidency, all the plan expenditure. So there was this distinction between plan and non-plan expenditure. All the plan expenditure was dumped into one number. So it was every year getting added up, and in the financial report showing up as a very long, huge number. So some people thought it's a proxy to the fixed assets. Is it really a proxy to the fixed assets is something which is anybody's guess. It can include practically anything which is treated as planned expenditure. So it included dams, it included roads, it included all kinds of fixed assets, it included all kinds of other expenditure also, which were coming from the 5-year plans of those days. So what level of, what's the ability of that information in delivering, aiding decision making? Practically zero. Those financial statements have grew over a period of time and improved. And right now, if you go back to the same state, you have a fixed assets register with various categories of assets. And what's the difference you see between those days and the reforms which were done on the fixed assets maintenance? It's not just maintenance of a fixed asset register. It actually transformed and influenced the overall PFM tone in that particular state, and eventually contributed to broader and stronger public sector reforms. So let me talk to you a little bit on the relevance of fixed asset management in the broader context of public financial management. Next slide, please. So when we say public financial management, what do we call as public financial management? It's the broad cycle. So from budget, the methods for budget reliability, transparency in public finances, management of assets and liabilities, policy-based fiscal strategy and budgeting, how predictable controls over exist and how predictable is the budget execution, how good financial reports and accounting are, and how it is audit is done. So this cycle typically is what the PFA pillars, the 7 pillars of public financial management. For those of you who may not be fully aware of PFA, so PFA is a partnership of 9 development partners housed in the World Bank Group. So this is considered as something like a global standard for public financial management. 153 countries use PFA, and there are several assessments at national and subnational level. Many colleagues actually in this group also would have conducted assessments or would have used the assessment reports. So in this whole cycle, PFA is actually trying to have an evidence-based approach to public financial management to make sure of 3 that each country achieves 3 key budgetary outcomes better. What are they? Fiscal discipline, don't spend more than what you have. Efficient resource allocation, allocate resources in an optimal way, which will contribute to efficient service delivery. And this framework provides the basis for strengthening PFM system. Now, where does fixed asset management fit into this broader scope of public financial management? So it most directly, the accounting aspects fit in at the accounting and reporting pillar. That's pillar number 6. But it has also strong connection with various other pillars. How do we say so? So management of assets and liabilities, how well a country or a state in a country manages its assets and liabilities. That's influences, that's very closely and directly the fixed assets reporting. And it has cross-cutting links with all other aspects, like a strong budget, a highly reliable budget would mean it would, the capital investments, the public investments into long-term asset creation will be more likely utilized. So that would have a kind of an impact on that. The transparency is linked to, again, the demonstrative effect of like how well financial statements report on the financial assets, the fixed assets as such, other than the financial assets. Now, Andreas and Pascal brilliantly presented this paper. I had this great opportunity to review this paper at some point of time. That presents essentially the core of what we talk as, like if we say accrual basis accounting. Many countries which are migrating from cash or modified cash to accrual basis accounting, the biggest challenge boils down to ability of the countries to do the fixed asset accounting right. So to that extent, this particular product of PULSAR, that's the foundation for probably a stronger and a more effective accrual accounting migration. The reason is pretty simple. So when a country moves from cash to accrual basis, one of the most fundamental worry or concern is that, okay, cash is known, we know how much it is, it's clear to understand and establish. Accrual is, it involves a lot of assumptions. You say depreciation, you make a lot of estimates, and you make a kind of an adjustment. So does this not make it easier for the people who are preparing the financial statements, make it subjective, and actually can there be not higher risk of window dressing when compared to pure cash, where the cash came in and cash went out? So that's much more objectively possible to report. And that's where we need this strong accounting standards using IPSAS to get the credibility in place that fixed assets are being reported on a consistent basis, and that alone will allow the decision makers, policy makers, to make use of the information in a much superior fashion. Now, in the subsequent slides, we'll see in the broader PFM context, are we really globally doing very well? Can we go to the next slide, Dimitri? So if we go to the, if we take a kind of a broader picture, so if you take the PIFA assessments of public financial management over a period of last 15, 18 years. So the good news for the world is like post pre-COVID era, almost all pillars of public financial management have been making progress. If you see the chart on the screen right now, you see everything over a period of time is going up. There's nothing, no indicator or no pillar which has significantly come down. But if you little bit more carefully notice, what is really lagging in this whole process is the accounting, recording, and reporting. This is something which for most of us who are actually focusing on financial reporting a cause of concern, because financial reporting is perhaps in the entire public financial management structure the most simple, objective, evidence-based technical exercise. If you take budget reliability, for example, whether whether budget is executed as per the plans is subject to views and judgment of politicians and the policy makers on whether they should subsidize particular activity. There are things which are political, structural in nature, which is not a pure technical exercise. Each of the pillars, including the audit, everything has dependencies with other aspects. The only area where there is zero dependency, we can straight away objectively work and deliver is financial reporting. And financial reporting in public financial management has not been improving as well as other pillars of public financial management, which is a kind of a serious concern to many of us who focus on this particular aspect of work. And within the financial reporting, this is even a kind of an disguised assessment. It hides the reality quite a bit in a way that, because PIFA doesn't require accrual accounting. PIFA requires whatever accounting is done, is it done better or not? That's the kind of a tone PIFA indicators take. So which would mean even this relatively not so attractive improvements of financial reporting would be even further lower if we objectively take a global view of how fixed assets accounting is being done in jurisdictions which follow accrual basis accounting. So in that context, again, the product put together by PULSAR fits in exceptionally well beyond PULSAR countries to the whole world. Next slide, please, Dimitri. So if we go to some regional analysis. So when I mentioned that generally public financial management systems globally are improving. So what about the region? That's the news in the region also. There are few cases where the the overall public financial management scores have come down. But when we say the overall scores have come down, there could be because of some specific reasons on some pillars or indicators. It may not be a kind of a universal problem. So the storyline, even at a kind of a regional level, is very positive, that over a period of time, we have been making progress. Countries have been making progress in public financial management reforms. And that possibly also influences our own ability to do fixed asset reporting even better. Next slide, please. So if we are looking at what is it like boiled down to within the overall PFM cycle, what does PIFA treat as directly fixed asset reporting related indicators? So there are three indicators: PI11, public investment management. So how well investment analysis is done in a country, so to take decisions. So this is the public investment management, which will be discussed a little later today in the session. And after that, it's the public asset management. Here, the non-financial asset monitoring. So this aspect, these two, the public asset management globally have not been really scored high in many of the assessments recently, which practically means that this itself is a weak area. And then if you link it to the financial reporting, the annual financial reporting, the reports, the completeness of annual financial reports, submission for external audit, and whether a country or a state subnational government follows accounting standards. So these three will constitutes the broader structure, within the broader structure, specific aspects of financial reporting issues relating to fixed assets. Next slide, please. So let me take you to a few broader issues. So picking up thoughts from what Pascal mentioned. So what you see in recording, the key aspect here I would like to highlight is, are we using the country's financial management information system for managing fixed assets? So there are different experiences. So there are asset IT systems being created in some countries globally, which is not a bad idea if we want to go ahead with that. But as long as overall the balances ideally are they reflected in the IFMIS system, because in a good overall system, the IFMIS system should be the one which is generating eventually the financial report, the balance sheet of government should come out from that, including a consolidated one if they are trying to consolidate. Then the report itself, the issues relating to compliance with IPSIS, that's or any other standards based on IPSIS. So the credibility of fixed assets reporting would purely be based on how well we do the reporting implementation of this accounting standard implementation. That will help fiscal governance. In some countries, fiscal councils are being created. These fiscal councils are like a kind of an agency which reviews the overall fiscal policies and decisions of the government as a part of the government, but with expert group. And these groups get immense kind of a value if we are in a position to provide fixed asset related information through the financial statements. And that also contributes to the fiscal policies to enable long-term sustainability. As we discussed in the previous session, materiality and cutoffs are extremely important. One of the fundamental criticism you find is the balance between cost and benefit of doing this fixed asset reporting. Are we spending too much without getting sufficient return out of it? So this is a country-specific issue. We should not complicate things, keep it simple and set the right cutoffs for materiality and have the process which will be easy and a kind of a clear line of sight from the place where the fixed asset exists to the financial statements. Internal audit and external audit's role are extremely important, particularly the supreme audit institutions. Their collaboration in building for the first time when strong fixed asset registers are maintained and being made use. So bringing that all together would be extremely important. These days we are also talking of green budget. So in green budgeting and green accounting, so government balance sheet should go green, which would mean assets which are fixed assets should be assessed also based on how well they support climate agenda, how well they support sustainable development in the country. So that's another area one would like to focus, probably particularly also from the natural resource accounting issues and how we report this as such. So lastly, to conclude, this is extremely important agenda. I'm so glad that most of the countries actually in PULSAR group are doing pioneering effort in this, which will be useful for the rest of the world. And PIFA Secretariat is very glad to collaborate with all of you. The last slide, I'll just leave with a thought from the PIFA Secretariat side. So for the many of you think that the PIFA scores, actually, where are the PIFA scores? Right now they're on the website, but they're in a form where you have to go and download individual countries. For the first time, what we did is to zip apart all the data and of PIFA public reports and put together a global report on public financial management, the international and the regional and country level trends on public financial management. So this report is being actually launched through a seminar starting next week. We hope sometime we'll do with the PULSAR group also in languages which are with translation to languages. Right now it's in 3 languages. Next week, some of you who may be interested are most welcome to join these open events. Thank you, and over to Dimitri.
Thank you, Srini. Now I would like to invite Svetlana to share with us her thoughts on the link between the fixed assets and public investment management, as well as to introduce our next speaker, it's Francisca.
Thank you very much, Dmitry. Can you see and hear me well? Yeah, great.
Loud and clear.
Yeah. So first of all, it's great to be invited again to this group. It is not our first event, and it's a pleasure to connect with the old and new friends. As Dmitry mentioned, my presentation will come jointly with the presentation, and actually I will lead to the presentation by Francisca M., who is a very special guest. She is going to introduce herself, but she works at one of the largest global institutional investors group, Allianz, which is headquartered in Germany. And what we would like to discuss today is the connection between the work that this group is doing, that is working on the accounting and reporting of fixed assets, and the broader government objectives. So what we would like to leave you with is appreciation of how your work is important for much broader parts of the government and for your society, for your citizens, for your country. So let us think a little bit. When we talk about the public investment management, what constitutes the largest share of public investments? It's actually investments in infrastructure. And by infrastructure, we don't mean just roads and bridges. We also mean the hospitals, the schools, everything that government is supposed to build and to deliver to fulfill its contract with the citizens. From the other perspective, infrastructure is a big part of what we refer to as fixed assets. So essentially, by working on fixed assets, by making sure that you have a comprehensive information on what government owns, how much it costs, where it is located, in which shape it is, you are really helping your government to plan new and additional investments in infrastructure. Now, let us make even further connection. When we talk about investments in infrastructure, we always have to think about how these investments are funded. So, and that there are usually two sources. Either government has to raise its own finance, either through taxation or through public debt, or government goes to the private sector and tries to find the modalities of bringing private sector investments in infrastructure. So once again, if you make this link from fixed assets to public investments, infrastructure, to public debt, or to public collaboration with the private sector, you really see how your work, what your departments are producing, is going to permeate a significant number of departments within your government. And actually, this is the point that has been touched on in the paper, and I would like to underscore it, is that as you are thinking what changes you need to make, what kind of reforms you need to make, you also need to think how you are going to coordinate these changes and reforms with what the other departments are doing. So now let us get back to the basics. Let us think how information that you are producing can be used by the governments as they're planning their engagement, in particular with the private sector. And engagement with the private sector has become, in the recent years, one of the sort of central topics for many government policy issues, such as sustainable post-COVID recovery, such as achievement of SDGs, achievement of the Paris Climate Agreement. Because if you think about it, it is really impossible to get where we globally and your respective governments are trying to get without very closely collaborating with the private sector. So now, it is not enough just to proclaim that the government wants to work with the private sector. Certain conditions have to be met for the private sector to be able to enter the market and to invest in certain country, in certain sector. And one of these key requirements is information about the potential project pipeline. Now, what is the project pipeline? It really is information about where and how the government needs to invest. So, for example, if you are looking at a particular area in your country and you see that your roads are in poor shape, or that your certain sector, energy sector, is in poor shape, and government would like to bring in the private sector, they would need to structure the pipeline of possible projects in such a way that the private sector will be able to connect to this pipeline. Now, where do they get this information? Normally, one of the first sources of information should be the fixed asset registers, where you should be able to go and to see exactly what do you have, how old are these structures or these roads or these factories, how much did you initially pay for them, how much has been depreciated, how much do you need to invest to keep them in the shape that you want to have. So that is that if provided that you have the quality of records that Andreas and Pascal have been earlier referring to, this would be a huge help to your government. Now, what happens if you don't have this information? Many things, and none of them is bad. Well, first, you may not even be able to target the specific areas where additional investments will have the maximum impact. Second, your government may overpay. So if you don't know what you have, if you don't have the full balance sheet information, and here it goes beyond fixed assets, of course, you also need, for the comprehensive analysis, you need to look at the liability side as well as asset side. Then you simply would not be able to take an informed decision on where your government should be targeting its efforts, its investments, and its fundraising, quote-unquote, activities. So with this in mind, another important consideration that I wanted to raise before giving the floor to Francisca, who is going to explain to us in further details how these private sector investors are looking at this information and what exactly they do, is that what is also very important and often is very challenging for the situations when governments and the private sector are trying to organize the long-term collaboration, is that these two segments speak very different language. So the public financial management language and the corporate financial language are often very different. You use different terms, you use different references. However, what helps is numbers, because numbers, the financial information that is supposed to come out of the government financial statements, including information on fixed assets, and as long as it is prepared based on the international standards, such as IPSAS, is something that everybody would be able to understand. So once again, by making sure that you follow the international standards, that your information is comprehensive, that it is accurate, ideally that it is auditable or has been audited, you can save significant efforts and significant financial resources to your governments as they're planning their future investments, both new and maintenance of the existing assets. That's a very important consideration, because in our work we have seen the cases where unnecessary new investments are being made when it would be sufficient to just upgrade what has already been in place. And this in particular applies to ECA region, to Eastern Europe and Central Asia region, since this is geographically, this is the territory where people have lived for many, many centuries. So many things have been built, many roads have been built, and they just need to be upgraded rather than entirely rebuilt. And then it helps also to the government to make the decision on the source of finance, whether it is necessary, absolutely necessary, to go to the markets and raise public debt, which raises a number of additional challenges, such as debt sustainability, debt transparency, etc., or whether you are actually in the situation where you would be able to build the pipeline of projects which will include information that is sufficient for the private sector to come in and to structure transaction in such a way that your government will not need to incur additional debt. To conclude my short intervention, I would say that this is something that, as I mentioned, this is something that we have seen picking up speed in the last few years at a few different levels, globally, regionally, led by countries, led by MDBs. At the World Bank, we hear more and more from our shareholders, governments that own us, that we also need to bring more of the private sector capital in the way we deal with the countries. So we anticipate that this agenda is going to grow. As Srini mentioned, and this is really a separate topic of for discussion, and I think we are going to have a separate webinar on this. Another consideration that is becoming increasingly important is sustainability, making sure that the investments that we make in infrastructure are sustainable. I'm not going to go into this area now because we want to stay focused on the fixed assets. So with this, I think it is a good point, Dmitry, to transfer to Franziska. So once again, Franziska is going to present to us perspective of the private sector, of the global institutional investor, which is interested in finding the way to invest their resources into infrastructure in emerging economies. However, they also have their limits, their frameworks, their requirements, and their responsibilities. So with this, Franziska, over to you.
Thank you, Svetlana. Franziska, go ahead.
Thank you. Thanks, Svetlana, for this very kind introduction, also your very comprehensive remarks. I'm going to share my presentation as well. So I'm very honored to be able today to speak to you and share our private sector perspective. And Dan has already mentioned in his opening remarks that the information generated by fixed asset management is valuable for various stakeholders. And I think also Svetlana made this point very strongly, that institutional investors are among one of these key stakeholders. As you might know, Allianz is one of the largest institutional investors globally. So how does this come? To answer this question, I would like to give you a very short overview of what we do and why companies like us can play a very important role in international finance. And also why it's important that investors and governments have more interaction to really leverage each other's strengths and to jointly drive sustainable development in the countries. So Allianz Investment Management manages the assets of our Allianz insurance companies worldwide. And as we offer insurance coverage in over 70 countries, we in total have a global portfolio size of 750 billion euros of pure insurance asset and 130 billion of unit-linked assets. And this just really illustrates you that insurance companies like us, but also pension funds, are by definition very large players in the financial markets, as we have to invest the capital on behalf of our policyholders. And given our liability profile, we are also very long-term investors. And this, I think, is in general a very good fit with infrastructure investments, as they are requiring investments for a very long period of time. However, when we talk about insurance companies, we also shouldn't forget that we are a highly regulated sector with very high capital requirements, especially if we start investing into risky asset classes or regions. At Allianz, we put a large emphasis on sustainability, and not only because we believe it's the right thing to do as a corporate citizen, but also because we think it's the right thing to do to protect the portfolios of our policyholders. And I would like to mention two key initiatives we are engaged with. The first one is we are a co-founder of the Net Zero Asset Owner Alliance. That's an alliance of asset owners who have committed to transform their investment portfolios to net zero by 2050. And the UN Secretary General just recently has mentioned this initiative as the gold standard for climate transition commitments. The second initiative I would like to mention is, which we are also co-chairing, is the Global Investors for Sustainable Development Alliance. And within this alliance, we are working together with the UN system and the MDB community, especially also with the World Bank, to really develop jointly solutions to channel more capital to the achievements of the SDGs. And I think in this context, channeling more capital to infrastructure investments is obviously a key component. So going to the next slide. I've talked about that we are a large investor. So what are concrete examples of how we can invest? And I would like to provide you with some real examples of how we are currently investing in the areas of renewables, infrastructure, but also blended finance. Starting with renewables, we have over 7 billion euros invested in renewable projects, which could be wind farms and solar farms, but also hydropower. And also countries outside of our core markets are interesting to us, as you can see that we have also invested in Malaysia and Indonesia in this respect. Renewables is definitely an asset class we would like to expand on, and also expand our geographical coverage to countries also outside of our core markets. The second area is infrastructure. And I've brought with me some examples from the infrastructure equity side, but obviously we are investing both in infrastructure equity and infrastructure debt. As you can see, we have been very active in investing into gas pipelines. So for example, our Czech investment was a purchase of the Net4Gas, which has a more than 3,600 kilometer long network of pipelines, which provide gas to the Czech Republic itself, but is also a key aspect in the European supply of gas. In Romania, we, for example, bought a stake in E.ON's Romanian entity. This was also our first investment into infrastructure equity in Eastern Europe. This was 2016. And the entity is now held by E.ON itself, the Romanian government, and Allianz. And it operates 20,000 kilometers of gas pipeline, and it also supplies the country's north via an electricity distribution grid of 80,000 kilometers. The last example here is an investment from India, which is a good example to show you how we engage also in road infrastructure. All these investments I've shared now with you have been brownfield projects. And brownfield refers to projects which are already constructed in an operating mode. However, we are also moving more into already financing greenfield projects. And greenfield means a project which is not yet finally constructed and thus also not yet operating. And obviously, greenfield projects have more risks because you also have the construction and technology risk. However, I think we believe that it's very important to also already start investing into these areas more strongly, especially if you think about our commitment to transition to net zero. You also have to support more the development of greenfield projects in this area. The last item I would like to mention on this page is blended finance. As I mentioned before, we are highly regulated. And therefore, there are obviously certain investments which are on a standalone basis too risky for us. However, luckily, there are ways how we can deal with the situation and solve it. And one of that is really blended finance for us, which in our opinion is a win-win situation for everyone involved. First, because we kind of bundle investments. So if you create a portfolio, obviously you have diversification benefits. And then blended finance really means bringing in public capital and private capital. And the public capital or capital, for example, from DFIs is used as a risk mitigating measure. So one option could be that it's observing as a first loss. So with this component, our risk profile as an institutional investor is reduced and actually reaches a threshold where we are then able to invest into this fund structure. And I think it's a win-win situation because first, obviously, we are able to invest, but also for the first loss capital provider, it's a win-win because on a standalone basis, they would be very limited of how much volume they can actually mobilize on their own for their investments. But if they are partnering up with the private capital side, they can really mobilize significant amounts of capital and create much more impact than they would be able to create on their own. And I've brought with me two examples where we've already done that. One is with IFC. Here we have committed 500 million into infrastructure projects in emerging markets. And another example is our investment with the German Ministry of Economic Development and the German Development Bank to invest into small and medium-sized companies in Africa. So I hope this gave you some kind of impression what kind of investments, we are interested in doing and would love to do more of. So the question now is what holds us back to invest more? And for us, we see three key issues, which I've put here on this slide. The first one is an insufficient pipeline, and Svetlana already touched upon that. Projects really need to be identified and planned for us to be able to invest because we are an institutional investor and not a project developer. And therefore, we need people on the ground, ideally from the government or from development institutions, really preparing these projects and making them to an investable state, which also includes having clear investment amounts, a defined time frame, and also a governance structure of it. The second key issue we are currently facing is a lack of transparency, because obviously some of the available projects for investments are not shared within the whole investor community, and therefore many of these projects are not visible for us. And the last item is the lack of risk mitigating measures. This is something I've just touched upon regarding blended finance. And just to repeat, blended finance for us is really a key solution because with a fund approach, first we need less first loss capital because we have the diversification benefits on a fund level, but we need first loss capital providers. And so far, we have only seen very few governments and DFIs who are actually engaging in this area. And this is for us really a missed opportunity to mobilize large amounts of private capital. And this brings me to my last slide. How can fixed asset management help to overcome some of the challenges I've just mentioned on the slide before? I think the key benefit of fixed asset management is really that it can provide transparency on data, benefiting the whole investment value chain of a project. So data is really key in our investment process. So starting with where is the impact the highest? I mean, countries normally know best where the development need is the strongest in their country and where the investment is most needed. However, to communicate this also to the investor community, you need to provide us with concrete data we can work with. The second topic is that project finance also has a long time frame from starting with a first discussion to actually the financial closure. And therefore, the earlier we know about projects being developed and getting more information on that, the better, because then we can also plan our due diligence processes accordingly. So providing us, with a pipeline, what also Svetlana mentioned before, of your planned investment needs is extremely helpful and necessary for us. The third item is really to attract capital for existing or new projects. Investors really need a track record of your past financial figures, because only with that we are able to investigate if this opportunity fits into our investment criteria. Which really brings me also to the fourth box here, the financial modeling and underwriting. I mean, here key data is really key. I mean, first, if it's already existing investments, which just needs kind of some remodeling or upgrade, obviously, like the past performances are important. But also if we talk about a new project, if you can provide us with data about a comparable project, already is a big improvement. And I think there's also a real incentive to provide this data, not only to get access to investors, but also to get better terms and conditions. Because normally uncertainty for us is priced in as a cost. So whenever you are able to provide more data, more transparency for us to make better underwriting decisions, this normally can also benefit your terms and conditions for financing. However, with the underwriting and the investment itself, obviously, our data requirements are not ending, because obviously also after making the investment, we need regulatory reporting and monitoring of the investment itself. And this also includes an impact measurement, because obviously we want to understand if the impact we have anticipated at the beginning of the investment are actually realizing in a fashion we have hoped for. So I hope I could highlight to you that transparent and comprehensive data is really a key factor of success to attract private capital. And to sum it up, I would like to repeat two key areas where we need to get better at jointly as the public side, but also the private side. The first one is really project development. We need more projects being developed on the ground. Currently, a lot of investors are competing for the investable projects, but there's just not sufficient supply coming to fulfill this demand. And on the other side, there are a lot of projects which haven't been developed to a state where investors can come in. And the second item is really blended finance structures. And we really need to jointly work on them. And just to emphasize, this is not to subsidize the private sector, but rather to move an investment from an uninvestable status above this threshold to make it investable. And in general, there are three categories of investments. There are some who are clearly bankable. And I think these you can really leave to the commercial banks and to the financial markets. They will find financing. And then there are also some investors who are clearly unbankable because maybe they don't have any revenue streams attached to them. And therefore, I think this is something which will also continue to be financed by the public side. However, there is this large sum of projects who are just in the middle, who just haven't made it above the threshold of being investable. And I think here, if we really join forces in creating this blended finance structures, we can really first mobilize large amounts of capital and actually lifting this above this threshold to make it investable. So thank you very much for listening to my perspective of an institutional investor. And I really hope that the public sector, the MDB community, and the private sector can work more closely together in the future to tackle the topics of sustainable development together. Thank you.
Thank you, Franziska. Our next speakers are Ingrita Makiut and Michal Bareja, who will present Lithuania and Poland examples. Colleagues, we have few time left, so please try to do it in 10 minutes. Thank you. Ingrida, you are first. Let me know if you need help with the presentation.
Good afternoon. It's a pleasure to participate in this interesting event and to share our experience relating to asset accounting, from determining opening balances of assets and their measurement as of the date of transition to accrual basis to ongoing works in this field. The accounting reform in the public sector was initiated in 2004 by performing the analysis of the current situation at that time, and the majority of financial information was not included in the accounting ledger and accordingly in financial statements of the public sector entity. The major part of land, some intangibles, biological assets, heritage assets were absent in accounting registers. The measurement was chaotic as well, based on some documents, indexation rules, neglecting the principles of prudence and economic relevance. So we started our reform with preparing and approving necessary legislation, and the major legislation pieces were accounting standards, mandatory chart of account, transition rules to the new chart of accounts, and government resolution on capitalization value and amortization and depreciation norms. And it was very important to prepare the detailed ledgers based on inventory count of all assets and liabilities as of the transition date, and to assure the detailed track of data. In this slide, you can see an example of bridging the old chart of accounts to the new one. And as you can see, the new one is much more detailed. As regards the asset registration in Lithuania, there is a rule to register all transactions in the accounting registries. Property, plant, and equipment is defined following the same criteria as in IPSAS. However, we have additional criteria for assigning asset to property, plant, and equipment: the acquisition cost. If the acquisition cost is 500 euro and higher, the asset is classified as property, plant, and equipment. And if the acquisition cost is lower than 500 euro, the asset is classified as inventory, except for real estate, heritage assets, valuables, registered vehicles, and guns, which are always classified as property, plant, and equipment. All assets initially are measured at cost or deemed cost, and subsequently all assets are measured at cost except for land, heritage assets, biological assets, and mineral resources. We have determined 9 classes of tangible fixed assets in the mandatory chart of accounts, corresponding with the same line items presented on the balance sheet. According to IPSAS, there are 2 measurement methods available to choose, but as the revaluation model requires periodic revaluations, it's quite expensive and burdensome, so we decided to have so-called a fair value method applicable for land and heritage assets. Our fair value model is based not on individual measurement of every item in most cases, but on the best data of market values our institutions have. For example, the Lithuanian Central Register has data of all real estate transactions and calculates average market values of similar assets in that area. So we use those values as a basis for measuring a fair value of land and heritage assets, real estate. A fair value of other heritage assets than real estate is based on insurance value, or if it's not available or cannot be, the other reliable value cannot be determined, a symbolic value of €1 could be applied. I would like to pay special attention to some extraordinary assets and specific nature of the accounting. In Lithuania, we have agreements when one public sector entity gives or leases an asset to the other entity for free, and the assets received under these agreements are accounted by grantors, but their improvement expenses, if they are material, can be capitalized by the lessees and amortized during agreement period. Other items for your interest might be, for example, specific for theater stage performances. Many components are registered under the caption of one item of tangible fixed assets, which is depreciated over planned performance period. The other example are libraries. For example, hundreds of books are grouped according to some selected criteria and accounted in the accounting registries as one item, but they are supported by detailed registers outside the accounting system. In Lithuania, we are implementing several projects and initiating some changes in our legislation in order to get data faster, in order to optimize processes. Decentralization of the accounting function is in the middle of the process. At the same time, the development of one IT system which would have necessary integration with asset management systems for public sector entity is ongoing. It should be noted that some entities which are managing huge quantities of assets like army, police, customs need separate asset management systems because of their specific nature. But in order the processes were smooth, the integration with the accounting and financial reporting system is required. We also seek to provide for mandatory use of electronic invoices when sales are made to public sector entities and data exchange with other systems. And to conclude, let me summarize what is important in order to implement the effective asset accounting. The first thing is to set up a separate account or ledger for every asset group which requires separate accounting treatment or presentation. The second, to define accounting and measurement rules. To develop accounting systems by taking into account the needs of asset managers and decision makers and provide for necessary integrations with the asset management systems. And the last but not least, in order to secure an appropriate implementation, it is very helpful to define who does what. The staff that orders and controls the assets has full information, so their responsibility is to provide the information on expected useful life of the asset, impairment, etc. to the accounting personnel. And the accounting personnel, based on accounting policy and data receipt, should register transactions in the accounting registries, so their responsibility is to ensure that the data in the accounting registries is complete for financial reporting. Let me stop here and thank you for your attention, as the time is very short given, so I'll transfer the word to Michal.
Thank you very much, Ingrida. Very interesting. Thank you for sharing Lithuanian experience. Michal, please go ahead. Ingrida, could you stop sharing the screen? Thank you.
Good afternoon, everybody. Is my presentation visible right now?
No, Michal. Let me know if you would like me to try.
How about now?
Yes, go ahead, please.
Thank you very much. My name is Michał Baraja and I work for Polish Ministry of Finance, and today I've got the pleasure to present you in a nutshell the way how we manage public sector fixed asset in Poland, and all the system is based on 3 different pieces of law. The first of them provides the general rules on how to use public assets, how to protect them, and what are the obligations of public sector entities. The other one provides the rules on sale, lease, donations, and other ways of disposal of assets. And finally, we got the Act on Accounting, which provide assets definition as well as the criteria for recognition and measurement. So the entire rules are standardized across public sector. And as for the general organization, we got the institution called Ministry of State Assets, which executes the property rights of the state toward its assets in relation to the assets which are not assigned to any other entity. This institution is supported by specialized agencies and state-owned corporations who take care about our specialized assets such as infrastructure or forests. And afterwards, at the end of the year, we are issuing a special report for our parliament, which summarizes state treasury assets in terms of their volumes and values. As for the general issues, we try to assign all the assets to the particular entities. So in terms of the register, which was referred at the beginning of our meeting, we have no centralized register. However, those registers are kept at the entity level. So we got a few thousand of such registries. However, those registers are run in a standardized way, as all the entities are using the same coding provided by Statistics Poland, so that the data are comparable. As for the fixed asset definition, it's provided in the Act on Accounting, and it's the same definition as is used in private sector, so it's IFRS compliant, and unfortunately right now it do not contain service potential component. However, all the items that meet this definition, and this includes both infrastructure, heritage, and military asset as well, must be kept in accounting books and presented in financial statements according to the general accounting rules. In general, all fixed assets are presented at historical cost, and here no revaluation model and no component accounting is allowed in Poland. And in case where the reliable valuation is not available, then the asset definition is met. However, the recognition criteria are not, and such assets are not presented in the balance sheet, and information on them is available only at the disclosure. As for capitalization thresholds, we decided to keep it flexible, and we decided to leave this decision for each entity that runs its register. However, what we observe in practice is that entities, the great majority of entities, decided to use the threshold set up in Polish tax law, which is 10,000 Polish zlotys, more or less 2,000 or 2,500 euros. And this same relates to depreciation methods and rates, as well as impairment and disclosures. However, for public sector entities, all the minimal level of disclosures is standardized, and those entities are supposed to present changes of fixed asset values, fair value of fixed assets, of course, if it's available, then the amounts of impairment and depreciation, the amounts and values of the assets which are leased, fixed assets under construction, and land under perpetual usufruct. And here is the country-specific issues, which is this perpetual usufruct of land, which in fact is a form of a very long-term lease with renewable, which is after this period is renewable, and the rates of such a lease are standardized across the country. So this is the way of our thinking of how not to sell our land, but still make it generate some profit for our country. And as for PPP contracts, both public and private sector entities are using the same accounting rules. provided in our national accounting standards, which combines both perspectives. As for the current challenges which we are facing, the first one is our try to enhance the system of financial statement consolidation, which would generate us new data needed to modernize our KPIs. We also try to enhance our IT, as the centralized IT is supporting just the budgetary planning and operations, so it keeps only financial assets. We want to expand it also to non-financial assets, and in order to expand it, we would also need to modernize our chart of accounts and create the standardized chart of accounts across the country, which is also under construction. And with this, thank you very much for attention.
Thank you, Michal. Very interesting to hear Poland experience on the topic. As usual, we don't have much time left, but I would like to invite Jose to facilitate the question and answer part of the session. Before that, we have been receiving requests to increase a little bit the volume of translation of our Spanish interpreter, if you can. Thank you, Luis.
Thank you very much, Dimitri. Can you hear me well?
Yes, Jose.
Perfect. Well, fortunately, the first three questions were already responded in the chat, but I would like to summarize the question for Andreas and for Srini. The question for Andreas is, which are the best practices in defining the capitalization thresholds for different government entities, vis-a-vis ministries and municipalities, and whether it is better to adjust the thresholds to the size of the entity or to have a uniform threshold. And the second question is for Srini on the PEFA evaluations. Maria Teresa Agüero from Paraguay was asking, what are the measures in place to account for the differences across time in the PIFA scores, as the teams performing the evaluation normally are different, and this can affect somehow the evaluation results. So we can go first to Andreas, please.
Yeah, thank you very much. Indeed, this is a question which is very practical for most governments, and it really depends on two factors. Firstly, if you have a very low threshold, for instance, like Australia, there is obviously no need to adjust the threshold for smaller entities, for instance, for municipalities. However, if your threshold is very high, like for instance in Switzerland, obviously you need to adjust it for smaller entities, because otherwise they would not recognize anything. The second argument, or the second thing to consider, is also the structure, political structure of a country. Obviously, if you have a more centralized unitarian structure, there's less need to make adjustments than in a decentralized or federal structure, where each entity also presents their financial statements and is held accountable for their financials. And so obviously a small municipality needs to present adequate financial statements. In this case, in a more centralistic country, it might be that they are consolidated into the national level. So this in a nutshell, Jose. Thank you very much.
Thank you very much, Andreas. Back to Srini then.
Thanks, Jose. This is a very important question. And PIFA Secretariat generally, as global public goods, provides lots of services free of cost to assessing teams and for countries. This includes, for example, training the assessment team, periodic trainings of consultants who usually are engaged for conducting the assessments. And very soon we are also going to launch a ePIFA, which is a kind of an training program online anyone can pursue. This is at one stage the quality assurance support that we provide. Another one is the PIFA check, which is the more very rigorous and the most credible process, because this PIFA check establishes the requirements which would mean that the report, an assessment report, satisfies the standards needed, expected out of a PIFA assessment. So it's a highly recommended process, though not mandatory. Countries can choose not to go through PIFA check process, but it adds to the credibility. PIFA Secretariat examines the evidence provided by the assessment team for a particular country with on how credible the scoring is, and issues this PIFA check credentials, which have of late been the default mode. Most of the countries are going for a PIFA check. So to that extent, there would be some kind of a degree of assurance on that. Last point, we should never view PIFA scores in absolutes and should not necessarily take the overall country perspective. Two levels. Each indicator has many dimensions. We need to unpack what's the core issue there in a particular dimension, if it is weak or strong, and also the underlying reasons. Often PIFA report doesn't fully cover all the underlying reasons because PIFA wants to be very evidence-based and not analyze. It's for the government and for the accountants to analyze the underlying reasons and take the right corrective actions through PFM reform strategies. Over. Thanks.
Thank you very much, Srini. We have one last question from the floor, which is, what do you think about the possibility of using ISO 55000 standards in asset management in the public sector? I think it's for Francisca and Andreas. Francisca, do you want to go first?
Hello. I'm not sure, but really refers to myself, I have to admit. So I would leave the floor to Andreas.
Okay, thank you, Francisca. Andreas?
Well, apologies. That's really sort of also out of my experience. I don't know if we open the floor for anyone. Maybe one of the countries has adopted that, but to my knowledge, in the government sector, no one has adopted these asset management standards. But please correct me if I'm wrong.
Thanks, Andrea. Dimitri, do you want to assign the question or go back to Arman?
No, maybe if we don't have any reaction from Ingrida or Michal, we can move on to the closing remarks.
Thank you.
Thank you, Dimitri. You can hear me, right?
Yes, Arman. Go ahead, please.
Yes, thank you. Thanks, dear colleagues. Thank you for a very good and comprehensive discussion on why and how to effectively manage public sector fixed assets. Of course, we started with the situation where we are now with the pandemic, and it was clear that effectively managing fixed assets will have its positive impact on the economic crisis and recovery phase and how we manage the current situation. Today's meeting was also very good, but we didn't only talk about the IPSAS requirements, but also about practicalities and considering the cost and resource limitations and how we can apply those requirements in practice. Particularly, it was a very good discussion about capitalization, and thanks to, of course, also country experiences, Lithuania, Poland, and on how the approach to capitalization thresholds have been discussed. It was presented also very good, interesting Australia and New Zealand as well as Switzerland experience of how this can be applied in the public sector. Another element was very interesting is valid accounting estimates, including the useful lives and how to determine those, that we need to look into the qualitative information and providing probably bandwidth to different classes of assets or their components. One key critical element, actually, many of our speakers they identified, is the institutionalization of the assets registry and its key element and key role they are going to play, including its connection with the chart of accounts. Of course, the key element here is why we manage this, how to manage it, and this is coming to the decision making, how we can make more effectively our decisions. And this is not only about availability of data, but it's how the data is structured, including it's about management system with key performance indicators. It's about linkages with program budgeting. It's about combining of financial and non-financial asset information. And for this, of course, many countries, I would say majority countries, they need strong also IT system or IFMS just to run properly the system, the fixed asset management system. It was also very interesting to learn that actually, while this is considered to be a top priority, PFAS demonstrate that financial reporting is not improving and probably one of the weakest links in the PFM cycle. And that also links to the public investment management and public asset management. As PIFA demonstrates, they are the weakest links, and we need to look into those. And who can address those in the public sector? Of course, these are not only accountants, methodology people who are developing the standards or methodologies, but these requires a much broader collaborative effort, as we discussed today, with many key players, including from the government, from the state property management or ministries. In Poland they call it's Department of Public Investment Management. It's about budgeting and fiscal department, it's treasury. Of course, internal audit and supreme audit institutions are also play a key role in this process. It was also interesting to learn that the private sector also, and just to confirm and to validate again, that private sector plays a key role in this process. And we can see that directly how we manage our fixed assets, the transparency and how comprehensive is the data. It will directly impact of how much investment we can attract as governments, and what are the terms of investments, as those affect the terms of the investment that we can see from Allianz. So I would like just to thank today for all the speakers for very useful and very insightful presentation and sharing your practical knowledge. And this is another, I would like just to state, this is another very useful PULSAR event. And thanks again for all the speakers, for country participants, and of course for organizers. And just please follow up on our pulsarprogram.org website, where we are going to post more knowledge products which are relevant for all the audience who joined today. Thank you very much, and back to Dmitry.
Thank you, Arman. Before everybody starts to disconnecting, I would like to make a couple of final announcements. As Dan mentioned earlier, we are currently working on organization of a couple of new events. One of them will be on sustainable reporting and its implication for public sector accounting. The other one will be a joint PEMPAL, PULSAR, and potentially FOCAL event on chart of accounts design. And finally, we are finalizing our next knowledge product. It will be on first-time IPSAS adoption. And we are also planning to organize another webinar to present its main finding in due time. Thank you again for joining us. We hope you found this event useful. Please stay safe and have a great rest of the day.